Hey, Brian, sorry for
All right.
jumping in here. It's really hard to hear you.
Let me get closer.
That's much better. Yep.
Okay, thank you. Prior to joining Schroders, he was a market strategist at Morgan Stanley from 2009 to 2016, providing advice to the firm's sales force and clients on a variety of topics. Prior to that, he was a credit strategist at Citigroup Smith Barney from 2000 to 2009, and he was an analyst before that at Marks Securities from 97 to 99. Without further ado, John Mackay and Hartford.
Thank you.
So I've been given a few questions that are commonly coming up in your conversations with advisor teams. And so I thought I would just start by asking you some questions, and then you can expand upon some of these questions. Sound good to you?
Sounds great.
All right, great. So with inflation at our highest level since the 1980s at the present moment, what is your outlook in the near term and maybe in the medium term on inflation?
Sure. So, it's a new market environment. We've been coming out of a disinflationary environment since the early 1980s. When inflation peaked, it was 1981 or 82. Paul Volcker crushed inflation by effectively putting the U.S. economy into a recession, hiking interest rates all the way up to about 15, 16%. And inflation, went down over the next 30 plus years. Prior to the coronavirus pandemic, we were in a very low growth, low inflationary environment, not just here in the US, but effectively around the world. Coming out of it, as we all know, with reopening, with supply chain issues, with very tight labor markets, we're now experiencing a very new high inflation environment. We have headline inflation, which includes things like food and fuel, up around 10%, and we have core inflation, which excludes food and fuel, around 6%. So to your point, Brian, we haven't seen numbers like that in quite some time. We will not stay at these high levels. Inflation will come down for a number of different reasons. The most prominent reason will be a fixing of the supply chain issues. China is reopening. Things are moving around the world. You can see that in shipping data. There are more ships out there delivering items to the US, to Europe, taking unfinished goods to places like Mexico and Southeast Asia, where they get finished and then they get shipped back. And that part of the inflationary story is going to go away over the next, say, 6 to 12 months. So it will come down. I think, unfortunately, in the intermediate term, inflation is going to remain higher than it was for the past 10 years for a number of different reasons. But the most prominent of those reasons is a tight labor market. Employees, for the first time in quite some time, are enjoying what we would describe as wage pricing power. So we're not quite in a wage inflationary spiral. But employees are getting higher wages. That gives them the ability to meet higher prices when they go out and spend on food, fuel, and discretionary items as well. And it becomes a self-reinforcing cycle. Some other factors that play into this as well are things like commodities. We think we're in the early stages of a commodity super cycle, as well as deglobalization. So offshoring becoming onshoring. So inflation is going to come down, but it's not going to go back to 1 to 2%. Our view is it will likely stay in that 3 to 4% range over the next 3 to 4 years.
Okay, so with that in mind, fixed income has suffered one of its worst 6-month period of time in bond history, coming off these artificially engineered low rates that the Fed had locked in place for the last pretty much 13 years. Maybe we should talk about, is this the time to abandon bonds, or are there opportunities now in fixed income or bonds for investors now?
I think it's more the latter. I definitely wouldn't abandon bonds. It's obviously been a very, very tough run, as you said, for the first 6 months of this year. We haven't seen numbers like this from a performance perspective in fixed income since the early 1980s, when Paul Volcker was hiking rates fairly dramatically. The nice thing about bonds, though, is that they come with a maturity date. So even if your price goes down, you bought a bond on Jan 1st, and now you're looking at it, maybe it's down 5 to 10%, somewhere in that area, it eventually will have what we call a pull to par, right? It will move up towards its par price, what you receive at maturity over time. And so the likelihood that we get over the next 6 months another 10% down in bonds is highly unlikely. So what we're advising investors do is we use the sell-off we've seen as an opportunity to improve your exposure in fixed income. And there are two areas we really, really like. One is taking on a little bit of duration, meaning buying longer duration bonds. You can get more yield today than you could 6 months ago. That yield will provide cushion for additional market volatility going forward. It obviously doesn't mean that interest rates can't continue to go up. We just don't think you're going to see another sort of 1.5% to 2% rise in long rates. If anything, it will be fairly marginal from here. The other area we like are in short duration credit. So think about companies issuing debt, whether it's an investment grade company that has a really strong balance sheet, or maybe it's a company that's high yield that has a little bit of a weaker balance sheet in short duration. So shorter maturities from those companies, again, you can pick up more yield today than you could 6 months ago. So I think those are interesting opportunities. One is more total return and one is more cushion. But I think that's how I think about fixed income today is the worst is probably behind us.
And that said, the move from virtually 0 to 3%, that's a big move. To go from 3 to 4, the rate of change is much smaller going forward, right?
Correct. I mean, look, it would still hurt, right? If, today we're sitting at about 3.1% on the 10-year treasury. If we got to 4% in the next month or 2 months, you're going to see that reflected in the total return in your portfolios, and that's not going to feel good. But again, to your point, it's not going from 0 to 3. 3.1 to 4 is only 0.9%. So it'll leave a little bit of a mark, but not nearly as badly as we saw earlier this year.
Okay, good. Now, one thing I'm hearing from folks is, markets are down. I'm losing on my cash. I'm losing on my bonds. Why should I stay invested here? Now, obviously, if I've been in the business a long time, I know why clients should stay invested. But speaking about the opportunity to make up for the loss in purchasing power, why are stocks still the best course for most investors?
So it's a really good question. And as you said, over time, I'm sure a lot of people on the line have seen charts about if you stay invested over the long term, you will generate, you'll generate a return on your investment, and it helps with retirement. You grow your wealth over time. This is no different. The worst time to invest, and it's very obvious in hindsight, but very hard to see it coming, is at the peak of an economic and the peak of a market cycle heading into a downturn. You could be down 30, 40, 50%. We're not going to see that. We're already down about 20% for the S&P 500 peak to trough, so that is a bear market. The market could go down further from here. But I think a key element of this cycle is that if we go into a recession over the next 6, 12, or 18 months, it is going to be a very, very mild recession. I've described it sort of as an academic recession rather than a recession we feel or see. Obviously, we all remember 2008, 2009. Banks were struggling, consumers were struggling. You could see it. You could see the price of houses drop. You could see people losing their jobs. You could see it in the market. 01, 02, and 03 was similar to that as well. It was a much longer duration economic drawdown as well as a market drawdown. You could see it in the headlines every single day. This is going to be less noticeable. I think it'll be a technical recession, and there's two really good reasons for that. One is leverage on the consumer balance sheet is extraordinarily low. Consumers are actually very, very healthy today. Leverage on corporate balance sheets is extremely low. Corporates are in really good shape today. And finally, banks are in good shape as well. So those three components are healthy. So if we go into recession, you've got more ability to bounce back from that quickly. So that means the market should sniff that out, and the market eventually will find its footing at a fair valuation given the economic outlook, and we'll bounce from there. And we can talk more about what elements of the market might do better than others, but I think that's where we are today, is maybe a little bit more downside in the market given the economic outlook, but not that much more to go. Similar to the bond story. Might hurt a little bit in the short term, but more upside over the next 3 to 5 years than you do downside over the next 6 months.
Okay, let's take a dive into the stock market. Obviously, there's a great rotation going on, and a lot of that rotation is centered around risk. If we look at the cryptocurrencies, they're down as much as 70%. We look at technology stocks, they're down anywhere from 30 to 80%, where value stocks have fared much better, mostly because they pay an income stream, so they're more easy to value than growth. So the speculative bubble, if you will, is coming out of the market first, which I think is very healthy. Maybe you can add some color to that and tell us, what we would probably like going forward from this sell-off.
Yeah, no, look, the way I've been describing it is similar to the way you just put it, right? It's the things you need versus the things you want. So when interest rates were at zero and we were getting all of this fiscal and monetary help because of the coronavirus pandemic that was global and economies were shut down, and so you need a lot of support from central banks as well as government spending, people could take on more risk, right? You had that backstop of fiscal support as well as monetary support. The fiscal support is now going away. The monetary support is no longer there. They're actually a headwind rather than a tailwind. And inflation is the backdrop. So the sectors and the areas of the market that have done well so far this year are cash has beaten bonds, value stocks have beaten growth stocks, international stocks have beaten US stocks, and commodities are beating the pants off everything. And the common thread between all of those winners versus the losers is inflation, and they, generally speaking, provide something we need, right? Food, fuel, shelter, clothing, healthcare. And to your point, those businesses tend to be fairly boring businesses for the most part. I'm generalizing here, but that means that they tend to be encouraged by their investors to pay higher dividends, share buybacks, things along those lines. And so that has been an interesting trend in the market. That's been the winners have been areas of the market that not a lot of investors have had exposure to in the past. They certainly won't overweight to. And those areas of the market were very undervalued. And so what we've seen a little bit here is a shift from the previous winners, which were, to your point, there was a speculative bubble in them. They were overvalued. Did you really need a cryptocurrency, another cryptocurrency in your portfolio? Did you really need a tech stock trading at 100 times forward earnings that does one thing? Maybe not. Maybe what you need is, a consumer staples company that does household goods or provides pharmaceutical supplies or, delivers to grocery stores or pulls the oil out of the ground and converts that into gasoline so that you can drive your car to work. Those are the kinds of businesses that have done better. And I'd be very surprised if that changed in the near term, given our inflation outlook.
Okay, good. So we're talking about a new regime of higher inflation and higher interest rates. If you think about that, I've seen several charts to kind of give you the quadrants, lower and falling. But now we're in the higher inflation and the higher interest rate environment. Can you give us a sense of which investments tend to perform best, or what asset classes perform best in the higher and higher quadrants of the interest rate and inflation?
Sure. So the way to think about it is the good that you produce, is it inelastic from a price perspective? Meaning it doesn't matter what price it's at, people need it and they will have to pay a higher price for it. Oil and commodities are the most obvious example of this. Oil is used in just about everything. Obviously, provides fuel for planes, trucks, buses, cars, boats, etc. It's also a source of power for buildings in some cases, as well as homes. And then industrial metals as well, used to build things, chemical production, and so on and so forth. So commodities will be the best performing asset class in a high inflationary environment. Inflation doesn't necessarily need to be moving higher consistently, it just has to be high. And then if you follow that thread down, it will be companies that produce things where the pricing is inelastic. So food is a fairly obvious one. Pharmaceutical supplies, generally speaking, are another one. Housing is another one. And then granted, it doesn't mean that people have to go and buy a mega mansion, or they have to buy a house that is too big for their family. They do need a house. And so that's the way I would think about it, is there's a little bit of nuance there as you get further away from the commodity space. But that's how I would think about an inflationary environment as well as a higher interest rate environment. Higher interest rates create competition for capital. Do you buy a bond yielding 3%, or maybe do you buy a corporate bond yielding 4 or 5%, or do you put your money in a stock that is trading at a really high multiple because it does, again, sort of picking on a couple of companies here, but it does one thing? I think that will at least make people, think harder about where they put their incremental dollar. And I think in a lot of cases, it will go to the companies that produce goods we need versus the companies that produce goods we want.
Okay, terrific. Now, you mentioned earlier in your comments, this might be an era of what you call the commodities super cycle. Can you expand on why you believe it's possibly the era of the commodities super cycle, and what does that mean longer term for possible portfolio positioning?
Sure, I'd be happy to. So I'm going to try and, I could spend an hour plus on this, so I'll try and keep it fairly short, and can certainly elaborate on any of these points. But I would think about it from a couple of different angles. One is we went through a major commodity bear market starting in about 2013-14. Oil prices had run up dramatically. Generally, what happens in commodities is when prices run up, you get supply coming on. So it's old, it's a very old, simple economic model. When the price is going up, you get a lot more supply coming on. Eventually, that supply outweighs demand and prices come back down. That's what happened in 2013 and 14. This time around, you've had demand going up, and you haven't had the usual accompanying increase in supply. And that is true for oil, it's true for nat gas, it's true for base metals like copper, aluminum, nickel, lithium, cobalt, etc. And it's even true in the food space, soft commodities like wheat, corn, soybean, and products like that. And what is the reason for that? One is a lot of those companies got burnt during the commodity bear market. And so their investors are basically telling them, look, hold off on increasing supply. Generally, increasing supply means they've got to spend money on hiring more workers, building more mines if you're a miner, buying equipment to do that. And so there's not enough money going into what we call CapEx, capital expenditures, to meet the increased demand. The third point, and this is more related to commodities, industrial base metals, as well as oil and gas, is ESG, or sustainable investing. A lot of investors, not every investor, but a lot of investors just don't want to own it because it's dirty. And I think that relates to the energy transition, moving towards more electric vehicles, more sustainable buildings, wind farms, and things along those lines. If you build a wind turbine, the biggest ingredient that goes into that wind turbine is copper, nickel, and lithium, all industrial metals that come out of the ground and are unbelievably dirty to pull out of the ground. So it's sort of this ironic twist on the sustainable investing movement, which we believe in, and we think it's not just us, it's a government policy thing in Europe as well as the US, places in Asia as well. Even China, which is one of the biggest polluters in the world, is moving towards a greener, more sustainable environmental policy because it's good for their middle class. And that's the only way the Chinese government stays in power. And so those elements create massive amounts of demand that is just not being met by supply. And I think that's not going to change anytime soon. So our view is that it'll end eventually, but you've got somewhere between 5 to 10 years of a potential commodity super cycle here that will lead to much higher commodity prices over that time frame.
Okay, so this is a great time, I think, then to dovetail how the war in Ukraine impacts, for example, food prices going forward, since they're such a large provider of food in the world, because part of the ESG movement by the Western world is causing commodity prices to be artificially, or at least for now, higher than they would be if we were willing to actually stick with fossil fuels. and it's creating this vacuum which Russia seems to be filling, where they're being enriched through the rising energy prices, and they're trying to rebuild the old USSR. Can you kind of go into sort of how the war plays into this and its knock-on effect to markets?
So I would have told you the same story about the commodity supercycle even before the war in Ukraine. The war in Ukraine obviously exacerbated short-term price movements in things like nat gas, especially nat gas, European nat gas. Germany, for example, imports more than 40% of their natural gas directly from Russia. The whole of Europe imports around 30% of their nat gas from Russia. Oil is it's, I wouldn't describe it as easy, but you can get away from Russian oil. You can import oil from Saudi Arabia, Africa. We produce a lot of oil here in the US. It's not the right mix of oil for fuel, but we can send that to a country that needs our oil, and they can send us oil that we can use in, in processing plants to make fuel. So Russia's invasion of Ukraine exacerbated these trends. And to your point also, Ukraine is a massive producer of wheat, third biggest. They generate, about 30 to 35% of global wheat supply. And you can't quickly create land and plant crops. It takes a year plus to convert land into usable space for creating wheat supply. And then there's a whole bunch of other things like phosphate for fertilizer, which impacts global food supply. So that's a short-term impact. I think, what eventually will happen, what we're hoping happens from a humanitarian perspective, is the Western world will squeeze Russia enough that they're forced to the negotiating table and they'll reach some kind of resolution. I have no idea what time frame that's going to be on. That will fade to the background, and so you'll take out that choke point for the supply of some of those goods that are coming out of Russia. But then you'll return to this commodity super cycle that's based on that supply-demand dynamic that just is not being met. I mean, ironically, even if Russia hadn't invaded Ukraine, our view in oil heading into the beginning of this year was that oil would easily get over $100 a barrel and would likely head up towards 150 to maybe even $200 a barrel towards the end of this year. We're not there yet, and that was based purely on our view that you had massive increase in demand and just not enough supply coming online. One of the quick things I'll finish on here on the supply side is, if you're a shale oil driller in the US, what you ended up doing over the past 10 years to keep those shale wells running, and you have to keep them running because they diminish over time. And what you were essentially doing is you were going to your old equipment and you were scavenging for bits and pieces from that old equipment. Those companies now have to rebuild their supply chain to keep those pumps running. The other issue they're running into is labor, skilled labor to run those wells. It just doesn't exist. And so it's not just a dynamic of shareholders saying, hey, don't spend money on drilling more. These companies physically can't do it. They can't get a hold of the supplies and they can't get a hold of labor. And that takes a long time to work its way through the system.
Okay, so we're looking at elevated energy prices for the near to medium, if not longer term.
Correct.
Okay. So at this point, I think that to summarize our conversation is, with the inflation being persistent, the only opportunity for return is really in either in commodities or in equities, but it's going to be bumpy along the way. But there's really no other opportunity out there, except that right now we're able to get better yields on our bonds. And if we're patient, our bonds will heal over time and we will get a return of our full principal. We just need to be patient. Would that be a good summary?
Yeah, I think that's a great way to put it. I mean, I hope I didn't come off as too pessimistic or a Debbie Downer, but I think it's just this new market paradigm is going to take a while for market participants, broadly speaking, both institutional investors as well as intermediary investors, to sort of wrap their head around. And I think there was a little bit of hope. My sense was there was hope that we'll just go back to the way it was, meaning 6 months ago, a year ago, maybe even 5 years ago, where the darlings of the equity market were US equities, growth equities, the FANGs. Bonds weren't that sexy. They didn't do a lot for your portfolio, but they certainly weren't that volatile. And I think we're just not going back to that anytime soon as long as inflation remains fairly high. But to your point, there are opportunities out there, commodity related, companies that produce things you need versus things you want. Your bonds will generate better returns going forward. It will take a little bit of time. And that's how I view the market opportunity set right now.
Okay. Now, it's been about 13 or 14 years that the U.S. has dominated over every other market from a performance standpoint, and they tend to move in cycles. And so this year, at least so far this year, international is outperforming the U.S. That may hold. That may become the new trend for a while. I know that's a lot related to the currency valuations. Does your team see opportunities now in the international and emerging market space that just haven't really been there the last 15 years, but now they really look good?
So we do. And I think one of the interesting things that's happened this year, if you told me on Jan 1st that Russia was going to invade Ukraine, oil and gas prices were going to go up to $120 a barrel for oil, and European gas has risen by about 300%. China was going to go into a COVID lockdown, and the dollar was going to rally by roughly 10 to 12%. That Europe was beating the U.S., Japan was beating the U.S., and EM was beating the U.S. I would have said you're crazy. There's no way. But I think what's basically happened is the following. All of those markets outside the U.S., again, I'm speaking in generalities here, but Europe is more value-oriented than growth-oriented. I would challenge anyone to come up with the best tech company that could compete with Amazon, Microsoft, Facebook, Netflix, et cetera, here in the U.S. from Europe. There just isn't one. They don't exist. Europe has a lot of oil companies. They have a lot of consumer staples companies. They have a lot of boring old businesses that do very, very well in a higher interest rate environment, as well as a commodity super cycle environment. Australia, Norway, Canada, Brazil, all the same story. The other thing that's starting to happen in emerging markets too is China went through a really, really rough run over the last year and a half. They had a tech crackdown. They had a real estate crackdown. They had COVID lockdowns. Growth was, going down to levels we thought we wouldn't see in the near term for China, around 4% to 4.5%. The market responded by selling off roughly 55% peak to trough. So a lot of the pain is already priced in China, and their market has actually run up about 18% since early April, even amidst all this market volatility. So I think the way I would think about international is that they do more things that are related to the things you need versus the things you want. They were cheap to begin with. They were not overcrowded. There was more money in the US than there was in overseas investments. And if the dollar even stabilizes a little bit and it doesn't continue to go up a lot, international equities will get that tailwind of a flat or even a weaker dollar would be huge for returns coming from overseas. So I think, to your point, hopefully this is the beginning of a new cycle where international does better than the US, but remains to be seen. But at least for the short term, for the next 6 to 12 months, I do think there's an opportunity in overseas equities.
And so, in the way that we approach things, we always hold every asset class. And so in a rebalance, you're naturally going to pick up the investments that haven't been working strategically and letting go of some of your higher flyers. And so rebalancing into the current environment might be really warranted, and you could take advantage of these price differentials.
For sure. I think that makes a ton of sense.
And we are at 12:30. I want to leave room for some Q&A. So I'm going to have Michael pull up the Q&A box and see what we've got.
Well, unfortunately, here we go.
This comes from a gentleman named Tom. His question is, what should we look for to know that the market has hit a bottom? We may have covered this in a different way. I guess this individual may sense that there's more downside in the near term. Perhaps you can address it from that perspective. But is there anything you look for that shows you? I know sometimes there's a capitulation trade. There's a volatility issue that you look at how the volatility is. What do you guys look at?
Yeah, so it's a really good question. I wish I could give you a concrete answer. It's obviously it's always obvious in hindsight, and usually what you get at the end of a bear market is a bottoming out. A bottoming out is almost always accompanied by a couple of days where the market's down 3 to 5%. It might be 3% one day, 2% the next. You look back over the last 3 days and it's down, 6 to 8%, and that is usually the bottoming process. We describe it as sort of the phases of the cycle, right? You get optimism, you get pessimism, you get despair. It's usually when despair sets in. So fair value, I'll give you some numbers and try not to make this too mathy, but the way the S&P 500, we'll just use that as a proxy for the broad US equity market. It's down 20%. We think you could get another 5 to 10% downside. That would put the S&P 500 at cheap valuation, slightly cheap to fair value. But unfortunately, what you will almost always get during that additional sell-off is an overshoot. The market always overshoots to the upside. It almost always overshoots to the downside. So that means all in, you might get 10 to 15% downside, as it finds its footing at a better valuation. So I wish I could give you a better concrete answer as the exact signs to look for, but I think I would look for those days where, you turn on CNBC or you open up the newspaper in the morning, and it's like the market plummets, 3 to 5%. That's usually a good sign that we're at or near the bottom.
Okay. Another question comes in from a gentleman named Bruce. He wants to know if an ultra short-term bond fund is still a good alternative to cash.
I think so. I mean, they come in a bunch of different guises. And actually, I would turn that question over to you guys, because I know you do this all day long for your clients. But I think it is. It obviously depends what that short-term bond fund contains. Is it super high quality, treasuries and agencies and things like that? Or T-bills, sorry, I should say, or does it contain a little bit of credit risk? I would actually go with a little bit of credit risk in my short-term bond fund these days.
So I would just point this out, Bruce, anybody else who's thinking of this question, it doesn't mean you're 100% guaranteed not for the principal not to drop. There's still a possibility the principal could drop in the short run. It'll drop significantly less than a traditional bond position. And you are going to collect dividends or interest payments between, say the high tenths to maybe as much as 2%. So you have to be careful what your trade-off is there. As long as you're a little bit patient, you should be okay in an ultra short bond fund as a cash alternative. Don't seem to have any more questions from our participants, but I just wanted to maybe ask this question to you. We're in a bear market. Obviously, we fell more than 20%. That, by definition, is a bear market. But bear markets have a period of time in which they last, and they can be brutal. We're 6 months into this one. The question is, what's the average bear market cycle? And also put that against the backdrop of the plunging consumer confidence as contraindicators that we might actually be looking at a lot more optimism, I guess, in market prices going forward. Can you do that for us?
Sure, I'd be happy to. So I don't have the numbers off the top of my head in terms of time frame, but I know the average bear market is down about 35 to 36%. So we're less than average, unfortunately, right now. But every bear market is different. Some are severe, like we experienced back in 2008, 2009. Some are milder, like we did in the 92, 93 recession, where the market was down 20%, but barely. And so, I would think this is going to be closer to a mild bear market than a severe one. Again, getting back to my point about maybe another 5 to 10% downside to get to fair value.
Okay.
And so, I think it is time, and are we seeing contraindicators? I'm not sure we are just yet. I think the battle for the market and the battle for economists out there is, what is the Fed going to do? The Fed's already hiked from 0 to 1.5% in the Fed funds rate. The market is currently pricing in they could get to 3.5% by March of next year. That is a very short amount of time. They started hiking in March this year, so you'd be talking about 12 months to go from 0 to 3.5%, which would be pretty incredible. So if the Fed stays on their course and continues to hike, and there's a lagged effect also to those hikes, and usually it's about 6 to 12 months before you start to see that play out in the economy. we could be in for a little bit of a rougher landing from a market's perspective than we've seen so far. But I'd be willing to bet the Fed is watching very closely what the market is doing on a day in, day out basis, how that's translating into the availability and the cost of capital for consumers and corporates. And if that number is getting bad, they're going to back off. And if they back off, that will help the consumer confidence numbers. That will help the market sentiment numbers. And that could mean we've neared the bottom if we're not there already. So a little bit of I realize I waffled a little bit on that answer. I didn't give you a clear one, but I think that's the key ingredient right now, that the market is just having a hard time knowing for sure what the Fed is going to do.
Sure. We got another question, and this comes in from Steve. What are your thoughts on Ibonds? I'll go ahead and take this one. Ibonds are inflation bonds that can be purchased through Treasury Direct, and they are currently paying to reflect the interest rates, not interest rates, but inflation rates. And so you can buy an Ibond with a 6-month window of, at the moment, I think 9% interest for that 6-month window. And I think it's a good thing for folks to do. Keep in mind, it is not 100% liquid. And then after 6 months, it resets, and you're capped on how much you can do. So you can, if we could, we'd put everything in those Ibonds right now, right? But that is a limited investment opportunity for folks. But I do like Ibonds for, maybe in replacement of what you might have bought a CD. Buying an Ibond through Treasury Direct is a great alternative. We are up against the 1240 window that we told folks this presentation would be. And so I just want to wrap up by thanking everyone for getting on the call today. Also thanking John Mackay for getting on with everyone to do this Q&A. We will make a replay of this presentation available within a day or two once it goes through our compliance department, and it will be available on our website and also in our blog posts. John, thank you for your time today.
My pleasure, Ryan. Thanks, everyone.
All right, take care.